Things have changed dramatically in 2020. A risk came about that many people had not predicted, and of course, no one had priced in to their economic models. Here we are today. We're seeing the disruption of value chains in a way that we never possibly could have imagined. In South Africa in particular, already a very vulnerable economy, many say this could be the tipping point, but of course, there are always opportunities within every single crisis.
This is certainly one of the most profound, I think, worldwide developments that I've had to deal with. The coronavirus, which is, I think, going to be the most impactful event of this century so far, given its global scope, as well as the impact it's going to have on us financially, economically, politically, and even socially. The global stage has been very dynamic because of globalization and how that continues to evolve and change, because of the challenges we face on the governance front that really has led to a lot of political upheaval in a lot of countries, and you see a lot of these fringe political groups coming to the fore. It's dynamic because of this digital environment that continues to expand and continues to change our lives in so many ways on a regular basis. And it's also dynamic because the three major world powers, Russia, China, and the United States, are adjusting their postures globally because of some changes they detect in the others. And then we see the European Union with the United Kingdom pulling out. There is a real question about whether or not these multilateral organizations, such as the European Union, are going to be beneficial. So as I look to the future, I just see that there are still a lot of things that are evolving. And again, looking at coronavirus, even before coronavirus, we had a lot. This just compounds it exponentially because of, I think, what's going to be a tremendous impact on the world economy, on individual economies, and how people are going to try to adapt to it. Our country, and I think our world, are very resilient. And I do believe we're going to get through this. But it really is going to require people at the senior levels of government to take their responsibilities to provide for their citizenry seriously. Too frequently, we have seen in many countries that those national interests are subordinated to personal or political interests. And sometimes it takes a shock like this to get us back, I think, on track.
I've been very bearish on the markets, but did I predict COVID-19? No, I did not. I did not do that at all. Did I also predict that the Russians and Saudis would decide to emulate themselves and start a price war into a recession? No, I did not predict that. That is almost impossible to predict. I'm not even sure what exactly they're trying to achieve there. From what I could tell, they really won the battle of the shale. But what I did know was that if you got a shock to the system, you would start to see these margins starting to be increased, and that would create a demand for cash and would start to liquidate assets. Normally, you can see the catalyst coming along and be pre-positioned for it, right? So you could see .com going to be a disaster and semiconductors a disaster back then. Housing, commodities, all these things, relatively easy ones. Now, COVID and Russia, Saudi price war, couldn't see it. But what the markets are saying to me now is we have not bottomed. And, in fact, there's a lot of technicals that say there's still way more downside.
First, it would be useful to explain what is machine learning. Well, machine learning, it really comes down to the set of algorithms that learn complex patterns in a high-dimensional space without being specifically directed. And with that, what I mean is that these algorithms our learning patterns without us imposing a particular structure on the data. In fact, that's precisely what the algorithm does. It learns what is the structure of the data. Do investors operating under panic show a kind of behavior that is detectable by these algorithms, whether it is panic caused by a virus or panic caused by a terrorist attack or panic caused by the flash crash or caused by Lehman or caused by the dot-com. All of these panics exhibit the same kind of footprint. And that's what the machine learning algorithm needs to learn. The fact that this panic is caused by coronavirus is in a sense anecdotal. The important is the panic behavior, and that's what machine learning algorithms can help us identify by looking into history, and therefore help us evaluate when the market is likely to exhibit the kind of sell-offs that we have observed in recent weeks.
This is not about sacrificing returns. The returns in, say, the green bond market are equal or better than comparable products of risk yields. This is a very important point. So the market is based on the idea of equivalent risk yield profiles with a bonus feature that the proceeds go towards addressing a long-term risk. So there is no haircut that is being asked for upfront by issuers. There was originally, it didn't work, and it wasn't going to work. If you're a pension fund or an insurance fund, you've got some regulatory requirements around risk yield. You've got things you've got to do. But you do also have this spectre of long-term destruction of your assets and liabilities, or your assets. And this was raised by the Institute of Actuaries in the United Kingdom 3 years ago, a major report, where they said on current trajectories of climate change, they expect to see wholesale decimation of portfolios by 2050 as the most likely outcome. The secret of this market is it can simply fit into existing portfolios. So it becomes a switching option. And the drivers of this market have not been mandated funds. They've been insurance funds and pension funds looking to switch bonds in and out that have this bonus feature, this extra feature, where the proceeds go to address long-term risk. That's a critical point.
How do you then price these unknowns into your economic models or just into the research that you're doing when things are changing so dramatically and people need clarity? I mean, in times of uncertainty, when it comes to markets or what the Rand is going to do, people need some kind of stability. Can you offer them that?
I think it's probably less about stability and it's more about clarifying the uncertainty. And you need to take out as many uncertainties as possible, or at least justify their existence. And so economics is a funny thing, because when we model, we try and justify economic theory. In this environment where your entire worldview is shattered, economic theory, or at least in the traditional sense, does not hold.
What is the main message that you're sending to the investor community and market participants that are watching this?
You know, this is the 11th year that we've done the Global Markets Seminar, and this year is particularly different because of the risks that we face. And I think the one important thing is, even though we have moved away from a traditional format of one-on-one engagement, I think that the ability to still relate information to investors at such an uncertain time is of value. And so we will use digital medium to be able to do that. But I think around the content specifically that we've heard today, the message is clear. There's no certainty in this environment. You have to be agile, you have to be flexible, because this was an unforeseen risk that was thrown in to the global mix. And the reality we envisaged at the beginning of the year is completely upended. You're basically trying to accommodate this ever-changing environment and saying, where's the value for investors? How do you influence their decision-making in this environment without compromising on your return, but also adding that social benefit?